Hello, good evening, everyone. Thank you for joining in the call. I'm Saurav Jain, Chief Marketing Officer at Union Mutual Fund, and we have on the call Hardik Vola, Fund Manager at Union Asset Management Company, Sanjay Bimbarkar, Fund Manager, and our CEO, Mr. G. Pradeep Kumar. Unfortunately, Vinay was supposed to be here on the call due to some personal, exigency. He will not be able to attend the call today. But we have seasoned fund managers in Hardik and Sanjay to take us through the valuation and the market outlook. Without taking any more time, I would like to hand over to Hardik to take us through the market outlook.
Thank you, Saurabh. I'll share my screen and I'll start the discussion. Thank you. Welcome everyone for our quarterly market outlook. We do this, as you all know, on a quarterly basis. We try to tell you how has been the general trend in the market, what has happened in the economy, and how are things looking. So this is our outlook. The last one communication we did with you was in March 2022, when markets had gone below fair value, and we gave you an update that things are looking very attractive from valuation perspective, and we don't get markets typically at the level that we were getting it at that time. And well, few 4 or 5 months have passed since then, so it's very proper for us to go ahead and give you an outlook since then. So let's start with how have things shaped up in terms of the outlook on growth, more importantly. So if we see what has happened over this period, the situation, the geopolitical tension in Europe has exacerbated. And what we have seen is that that has had an impact on multiple aspects of the economies. There is an impact clearly on inflation. We have all been hearing about what has happened because of it. Energy prices have rocketed up, and even the impact on other commodity prices was felt. So this has led to a big inflationary concern across countries. And at the same time, IMF has given an outlook. So we share this slide with you every quarter and show you what has happened. This time it is very peculiar about what is peculiar about the IMF outlook is that if you have been tracking our presentations and the IMF outlook that we also track along with you, whatever was the loss of GDP due to the COVID, due to lockdowns across the world in different parts of the world in India, if let's say the growth rate for 1 year was taken down by 1%, IMF would add that 1% to the next year, saying that whatever is the impact is temporary and the next 1 year will compensate for the slower growth in the year that is going on. This happened throughout 2020 and 2021. In both these calendar years, any downgrade in growth was basically assumed to be short-term in nature. But perhaps for the first time since the pandemic has started, the IMF has actually gone ahead and reduced the growth expectation for economies, not only for the next 1 year, but the year after that as well. So the calendar year 2022 is supposed to be growing much slower than what was earlier anticipated, and nothing has been added back to the growth expectation of 2023 calendar year, which means that IMF is in a way communicating a sustained slowdown or a sustained slower growth than what was anticipated earlier. The reasons for this, of course, were the same things that I mentioned at the beginning of the call. The geopolitical situation exacerbating was one, but the inflation that went up with it and the monetary policies globally became more hawkish, and that has caused this reduced growth expectation. 2 points to take away from here, apart from the fact that while the growth is supposed to be sustainably slower than what was expected, India is still expected to be a faster growing economy compared to all the emerging developed economies, and of course faster than the world. So as you can see, India will still grow at 7.5–6% for the next 2 years, which is way faster than what we are seeing in emerging markets as well. And that is perhaps a testimony to our government's initiatives. We will be talking about that in the later part of the presentation. But that's how the IMF has charted out the growth trajectory for the next 1–2 years. Lower than expected growth, but India to be the fastest. And as I was saying, that the reason behind this is, of course, the geopolitical tensions and the impact it has had. The central banks globally have responded to this inflationary concern and have increased interest rates in most of the countries. In fact, as the Fed minutes yesterday highlighted, that 8 of the advanced economies have increased their interest rates. And as you can see, countries like USA, the Eurozone, UK, Australia, all these countries have seen an increase in the interest rate. So you've just highlighted, just for depiction purpose, some of the major central banks which have taken an increase in the interest rates along with India. And the ones which haven't, so Japan has, of course, Bank of Japan has still maintained an accommodative stance. And there, of course, you have seen that the currency has basically depreciated, and that will lead to, of course, its own set of challenges by doing that. So the monetary policies, of course, have become more tightened, and the actions continue to be so. So we have recently heard even the inflation in some of these countries not abating. So further rate increases expected, as this chart indicates that in the US itself, even from now, even after the increase in interest rates that we have seen, from here itself, another 100 to about 100 basis points of rate hike is further expected. Now, the pace can be argued whether it will be front-ended, it will be more plateaued out, but it is going to be there. And that is the point, that compared to even, let's say, a year ago, the expectation as to what will be the increase in interest rates, that has itself gone up by 300 basis points. So if a year ago you asked market participants what will be the increase in interest rates in the US 2 years down the line, people would have said a certain number. Let's say that time the number was close to 1.5 to 2%. That number itself has gone up to about 3.5%. So the expectation of what the interest rate is going to be in the US has increased over a period of time. And of course, this is not all just to keep in mind the growth that has come pretty much sharply than expected in the past, but more importantly, to fight inflation. And as this chart shows, inflation, and this is the core inflation, so it takes out all the volatility that you can see from food and fuel. So this is the core inflation, which is X of food and fuel, on a 3-year CAGR basis. And we're using 3-year CAGR because the pandemic has basically affected different parts of the world in different ways. So we are trying to compare inflation as it existed in July 2019, and we are comparing it with July 2022. So over these 3 years, inflation is up by 6%. So it's not just because of the pandemic or some base being favorable. On the long run in India, the core inflation is up by 6%, 5.8 to be precise, and in US it's up by 4%. Which is significantly higher than their own comfortable rate of 2% inflation that they expect. So this is the level of inflation that has caused the central banks to react. Now, I think the recent trend and the point of communication and discussion has been that certain commodity prices have cooled off, and hence the inflationary pressures have reduced, have eased off. While that is the case, what we want to draw your attention to is still they are above their some of the commodity prices. So we have a common commodity index, Bloomberg, which basically helps us understand how major commodities in the proportion of their importance, an index is created and how that has moved. As you can see, while there is some cooling off, but still the commodity index is higher than their long-term average. So to that extent, inflation is definitely higher on the commodity side of things. And commodities do make up about 50 to 60% of the inflation in any country's inflation basket. So to that extent, till the time the commodities will be sticky to the upside in terms of prices, the inflations will be, the inflationary impact probably will be sticky to the upside. And even excluding that, as we showed you, the core inflation is high. So this is the reason why we have seen that there is a increased decision taken by all the central banks to control inflation, because you can't allow inflation to remain at the level it is. In fact, high inflation had already started affecting demand. So if you have been reading commentaries of some of the companies in the developed world, which are consumer facing, which sell products to consumers, they have been highlighting that they have to take inventory write downs, and or more importantly, they have to slow down their business so that the inventory in the channel gets used up. And what we want to tell you is this increase in interest rates that has happened. Actually, this increase in interest rates is not something that has yet come to play. So what I mean is, let's say in India, for example, the higher interest rates only have started to be passed on to consumers since 31st of July, 31st of August. Housing finance, housing loans are only seeing an increase in interest rates now. So while there is an agreement as far as the trajectory of inflation and trajectory of the interest rate increase is concerned globally, what I think still needs to be understood is what impact this higher interest rates will have on economies. We have had 2 years of very strong increase in liquidity globally, and now that liquidity is being sucked out. So we do believe that this will have an impact on growth. Consumers will see an impact of higher interest rates affecting their demand patterns, and that will in turn have an impact on the growth of companies that operate in these economies. So that is, I think, not adequately captured at this point of time, and this is a scenario in which we are today. That while the expectation of interest rates has moderated, the impact that it could leave on economies is still not perfectly understood, and more importantly, we believe is not yet completely captured. So with that, this was just the reason why we are cautious at this point of time. We have been maintaining in our commentaries that we are cautiously optimistic on India from a longer term perspective, but this is the reason why we have been cautious at the moment. So with that, I'll invite my colleague Sanjay to briefly talk about how the situation is panning out.
Sure. Thanks. Thanks, Hadik. So just to give you this backdrop of what is happening on the macroeconomy first, and then I will connect to you from the bottom-up approach, which we also look at when we are selecting stocks, etc. So as Hardik was highlighting, globally, obviously, there are many variables which are changing with respect to inflation, interest rate. But let's see what's happening in India. So obviously, these are large macro factors which are playing out on the global theater as such. And in India, we are seeing the similar ripple effect. So in India also, we have seen higher inflation in recent past, which is visible from the right chart on the screen. And banking liquidity is also coming down over a period of time, as we can see. We have already seen 140 bips of 1.4% of rate increases across last 4 months as such. And our stance taken by RBI is also to balance between the growth as well as the foreign exchange, as well as the kind of liquidity which we are having. So tightening monetary policy is something which we are also seeing. And as Hardik was mentioning, it is likely to have impact over a period of time on multiple layers. So from the corporate borrowing to consumer level borrowing to how consumer try to spend, what kind of discretionary income consumers have. And these players will get played into our economy over a period of time. Next slide, please, Habib. Now, coming back on the bottom-up side, if you look at one big variable which plays out in India is obviously monsoon. And the monsoon is running at 10% above the long-term average as such. Our Kharif zone area, as well as the water reservoir levels are tracking quite well. And this is particularly important since rural economy is quite a big economy for us. Typically, it constitutes 1/3 of the demand, but incremental demand is actually coming from rural area. And that's why good monsoon is quite a big variable when we are looking at a growth, incremental growth, which happens in our consumer sector as well as in the other areas of the economy. So this good monsoon is one big relief for Indian consumers as of now. And going ahead, this will play out in this particular year, FY23 as such. And currently we are running 10% above the long-term average on the monsoon side. Yes. So now this is very important slide, and I would dwell some time on this slide. If you look at this slide is actually from budget of this year, and what this slide indicates is where government is trying to spend. So as we all have seen, we know where government is spending approximately 7.5 lakh crore rupees is being spent on infrastructure, but the nature of spend or nature of Indian economy is changing. So if you look at, we constitute 18% of the workforce of the world, and whereas our GDP share is merely 3%, our manufacturing share is 3.2% as such, and that is what government is trying to change. And despite this overall deficit to GDP ratios, which are now increasing, what government is changing is also the nature of spend. So earlier government used to spend on, let's say, subsidies for fuel. Now government is spending on EV vehicles. Earlier government used to spend on facilitating subsidies. Now government is spending on increasing the manufacturing spend or manufacturing infrastructure for our businesses as such. If you look at for last multiple years, we have gone through a lot of pain, maybe led to GST, maybe led to demonetization as such. But now those foundational developments are now behind us. We have done heavy lifting. Our banking sector is now cleaned, is having clean balance sheet. Most of the NPA, GNPA pressure is now behind us. And now going ahead, what we are looking at is actually faster clip growth, which can happen. And that's what Indian corporate houses are now preparing for. I think next slide, please. Yes. So if you look at last, if you just shift back and understand what has happened or what has transpired in the economy for last 15 years, I will. So these are the various schemes which are run by government, which are declared, and some of the things are already are taking shape as such. So, for example, Air India kind of disinvestment that has already taken place. PLI schemes are already announced, and many sectors are now in process of setting up plants and starting the production. Some of the industries have already gone ahead and started the production and getting the benefits of this PLI production-linked incentive schemes as such. But I just wanted to understand this from a quantitative perspective and wanted us to attach this to some number. And let us do that exercise for a minute. So if you look at 2010 versus 2020, what has changed in the Indian economy as such? So for example, if you look at the decade of 2010, our average distance traveled by truck was around 250 kilometers. Today, our trucks are traveling anywhere between 450 to 600 kilometers on a per day basis. Average lanes per kilometer of national highway was 2.2 at that time. Today, we have average lanes per kilometer of national highway are 3.2 lanes per kilometer. Earlier, our power peak deficit was 11%. Now our power peak deficit is merely 1%. Earlier, port turnaround time, the turnaround time when one batch of goods reaches the port for either import or export, the turnaround time at the port was 4 to 5 days. Now it is less than 3 days. So where it leads to, what quantitative impact it has is simply that earlier logistic cost as a percentage of sales for our manufacturing companies was around 5.8%. Now it is below 4.7%. So this 1.1% saving, which is very material saving from manufacturer perspective, when you consider that typically manufacturing industry has 8, 9, 10% kind of margin, this 1% saving on the overall cost leads to 10% profit jump for them. We have already taken, government has already taken this tax related initiatives where they reduce the peak corporate tax from 33% to 25%. In fact, for new companies which are setting up new units, there was incentive given at most at 17%. So we are very competitive in the global landscape of things. If you look at from the manufacturing perspective, that is where we are looking going ahead. Where as I was talking about, our working age population share is 18%, but manufacturing share in GDP for the global GDP, or if you look at on the manufacturing GDP market share in terms of world, is merely 3.1%. And that's what we are trying to change going ahead. So how will we change this? So one is the incentive or the spend which government is doing is on the right side of things, where production linked incentive schemes, etc., are being talked about, are being given, and incentives are started to roll out now. Apart from that, these reforms, particularly with respect to GST tax systems, etc., are already taken place, and that is the area which we have already acted on. If you look at 2008 to 2020, what had transpired in that decade was actually very slow growth. In fact, 5 industries, particularly if you look at PSU banking, metals, oil and gas, telecom, led to a lot of losses during that period of time and led to significant drag on corporate GDP. So corporate profitability. So if you look at corporate profitability to GDP ratio, which was 7.8 in the year of 2008, which fell to 2.2 in 2020. And now we are looking to grow it going ahead. And that's where our Indian corporate overall ecosystem is staring at. Now going ahead, considering these overall schemes which are launched by the government, and in last 5-7 years, the efforts of corporate which have taken place, where those efforts were directed. In last 5-7 years, a lot of work has happened on the cost saving initiatives. A lot of capacities were developed by these corporates are now sitting idle, and corporate capacity utilization was falling a few years back. And now, since the growth is coming back as the economies are normalizing, now we are looking at this corporate capacity utilization to grow. So for example, yarn capacities, or for example, overall manufacturing capacities, if you look at cement capacities, steel capacities, those are now getting utilized as our economy is opening up and as the growth is coming back to India. Not only domestic growth, but we are also focused on the export driven growth going ahead. So if you look at, we have a democratic governance system. Apart from that, we have now revamped taxation system. There is a rule of or law of land, which is consistently followed across India. India is now getting united under this one umbrella of taxation, particularly GST, or if you look at income tax. And corporates are taking benefit of these kind of environment which government is creating, and the many MNCs which have had relations in India, or particularly on the auto sector or on the consumer electronics sector, those companies are now going ahead and are looking to make India as a manufacturing powerhouse and rather a sourcing hub for their global supply chain. So during last couple of years, because of the geopolitical situation, Chinese dependence on Chinese ecosystem, particularly for manufacturing, was one of the kind of impediment for global growth, and that is what is being changed, and that is what is being targeted by the global corporate boards. And India is being considered as a manufacturing hub for global supply chains, and that is what is changing in India. And I just wanted to put that perspective through this slide. And as I was mentioning, so these changes are subtle changes. Some of the changes where we see now FASTag getting implemented. To see that is a one change, but in fact, actually, it has a lot of ripple effect on the overall efficiency, lot of effect on the ROE, which or turnaround times, leading to higher ROE for the transporters and for the manufacturing sector as such. And that's what I wanted to highlight through this reduction in the logistic cost, which I just talked about, that logistic cost itself has reduced by 1%. Supply chain is being amended for as such in India. Now we are looking at manufacturing semiconductor factories and manufacturing semiconductor itself in India. If you look at 10 years back, we wouldn't have imagined that iPhones will be manufactured in India. Today, we are manufacturing iPhones, or in fact exporting iPhones. And this is the change which is there in India. And that is what is visible in our corporate sectors, as well as through some of the areas which we can invest in the equity market. And that's why, if you look at from the cyclical perspective, not only we are at a clip of fast cyclical recovery in the banking sector, but manufacturing sector, services sector are also having the similar areas of growth going ahead. And that's what we are targeting. That's what we are looking at from Union Mutual Fund perspective. I think next slide, please. Yes. So since Hardik gave the backdrop on the overall macroeconomic variables, which are obviously kind of concerning, that inflation is rising, interest rates are increasing, and over a period of time, it will have ripple effects on the demand from the consumer side. On the other side, India is particularly becoming attractive because of the hard work or heavy lifting which we have already done through in last 5-7 years through these changes in the ecosystem which I just mentioned about. So what it is leading to? So if you look at, we are as a mutual fund investor, we invest in equities, and how equities typically make money is on the return. We make money on the return on equity, and on the other side, we as a corporate, we have to buy our capital, and we have to pay the cost of capital on the other side. So in short, as a equity investor, we have this, we get this gap between the ROE and cost of funding is something which we make ourselves as a return. So on the ROE side, as I was mentioning, as capacity utilization, etc., is expected to increase, ROEs are expected to grow going ahead. But on the other side, cost of funding is one risk. That cost of funding itself is also growing. And this is what is visible through our fair value calculation. So our fair values, which were below, so Nifty was trading at below fair value till some time. Now Nifty is trading at a faster, now Nifty is trading at an expensive valuation than our fair value. So the blue line, which is visible on the left side of the screen, is now trading at a premium to the fair value. Historically, our experience suggests that Nifty tracks fair value growth over longer period of time, and that's where you will see that Nifty is much more volatile. But where fair value goes, Nifty typically follows that line over a period of time. Currently, our anticipation is that this fair value growth is expected to be in double digit. Currently, Nifty is trading at a slight premium to fair value. In fact, as on the July end, it was a single digit premium to the fair value. That's where the Nifty was trading at, indicating that it is still at a reasonable valuation if you compare to history. Next slide, please. Great. So, let me hand it over to Hardik to cover the headwinds part and some of the sectors, and then I will come back.
Great. So yeah, just to summarize what we wanted to convey through this update, the things that that is keeping us cautious at the moment are the risks specifically culminating from the increase in interest rates globally, and the impact that this is having already on liquidity, and the impact that it can actually have going forward, which is not yet, as I said, completely understood, the impact it will have from in terms of its recessionary pressures. So for example, yesterday's FOMC minutes, the number of participants that ascribed the probability of a recession in the US, that number of participants ascribing the probability increased, and the probability itself also was on the margin a little higher. So even incrementally, people are afraid, or rather there is a worry that there will be a recessionary pressure coming into economies, and that's what the IMF is also indicating. However, since a positive growth is still expected for the full year, the expectation still is that the recessionary pressures will be short-term in nature, but we don't understand completely the impact of it. The other thing that keeps us worried at this point of time is the unknown or unintended consequences of the ongoing geopolitical tension between Russia and Ukraine. What impact this will have. So bear in mind that the winter is yet to come, and with the winter coming on and this energy prices being where they are, in fact, maybe the demand supply mismatch being higher during those winter months, probably will have some more knock-on effects which we don't understand yet completely on the economies and on inflation. So that is another area of risk. And apart from that, of course, relatedly, what impact it will eventually have on the inflation, as well as in turn the impact on profitability, as well as the demand patterns of the consumers. These are the issues that we find that are a problem in the near to medium term that needs to be answered or understood. And with that, these are the short-term headwinds that we have while we are keeping a long-term positive stance on the points that Sanjay mentioned.
Sure. Yeah. So as I was discussing with you, the tailwinds to the Indian economy are obviously reasonable valuations, healthy fair value growth. We are looking at double-digit growth in the fair value going ahead because of the hard work which you already gone through and the heavy lifting which we have done as such. Low corporate taxes, government stimulus programs. So typically it is discussed that China, because of the scale, has 5 to 6% kind of benefit in their manufacturing, and that is what is being given by the Indian government as well through these PLI schemes. Exactly 5 to 6% kind of incentives are being given, and these are the kind of a countervailing arguments on the growth going ahead for the Indian equity market as such. Having said that, we are currently looking at a market scenario which is very volatile. The macroeconomic variables which Hardik highlighted, particularly on the interest rate, inflation, the impact they will have over a period of time as those interest rate gets passed on to the consumer needs to be understood. And that's why we believe that large caps, which are much more evolved companies with having stronger balance sheets, which have more developed nature of business, those are the areas where we are having more preference over mid and small caps. Though there will be faster growth in some of the mid and small caps, the higher risk which those businesses are facing are also higher. That's why preferring large caps over mid cap and small cap at the current juncture. On the overall sector preference, since we are coming out from this cyclical, we are coming in a very cyclical recovery and growth area going ahead. We are positive on the financials. So just to give you a highlight, in last calendar year, government almost cleared 5,500 projects as such. And last year's announcements are typically this year is capex, and that's what we are seeing in the banking recovery, where banking sector credit growth itself, which was around 8-9% a couple of months back, is now trending around 14-15% level of system credit growth. So these recovery is also showing up in the data, and that's why we are positive on the financial sector. We are positive on the consumer discretionary sector, which is actually a broader basket, which includes automobiles, retail. So as economies are opening up, as income levels are rising over India, we can see there's demand for automobiles, which has been in downturn for last multiple years. So just mind you that we have not even crossed the kind of cars we sell or kind of two-wheelers we sell, which we sold in 2019. That level itself we have not yet crossed, and so those recovery is possibly ahead of us, and that's why we are positive on this consumer discretionary sector as such. Handing to Hardik for other points, and then we'll...
Yeah, sure. So other sectors that we are also bullish on at the moment are communication services, which is telecom. What we have seen is that during this pandemic, one commodity that has definitely significantly increased in terms of its usage is data and telecommunication services. And at the same time, the competitive intensity in this particular industry has also reduced. As the information is now coming through, the top two players in the industry, both of them have close to 30% market share between the two of them. And to that extent, incremental market share that is needs to be won has reduced. So now since the market share related fights probably are over, the expectation is that going forward, these entities who are there in this space will probably benefit from their market that is relatively more consolidated. So ARPUs, that is the average revenue per user, is expected to basically go up. It has already gone up pretty substantially over the last 2.5-3 years. The expectation that it will continue to increase, and also with the migration to relatively newer or the upper end of the telecommunication services, that will basically result in an operating leverage, not necessarily playing out in the P&L, but definitely from the return on equity perspective, because incremental capital needed to drive this growth will be low, and the incremental growth that will show up in the profits will be way higher. So we continue to like the sector from that perspective. We are also bullish on the industrial space, which in effect basically is bullish on the government as well as private capex. As the point Sanjay mentioned, both on logistics, how bottlenecks on supply chain are opening up, how the capacity utilizations because of this have also increased over a period of time, and more important, because of the heavy lifting that the government has done by giving these tax reforms way back in 2019, actually September 2019 to be more precise. All this has attracted more and more manufacturing attention in our country. And we have seen, as Sanjay also correctly pointed out, that now we are seeing important products like even the iPhones being manufactured, important companies manufacturing their high-end devices in our country. More importantly, even some of the MNCs who have been present in India for more than 2 to 3 decades, they are incrementally asking their Indian subsidiaries to do more of their manufacturing for their global parts. So many MNCs actually have gone ahead and taken proposals to do more work from their Indian businesses, have basically taken up a shareholder approval basically to do more manufacturing for the other emerging market businesses. So to that extent, we are very bullish on the private capex, and hence industrials, which is a play on private capex as well as government capex, and also to that extent on some of the other power related capex that can happen. We are playing many companies in that sector through that space. That is the other area we like. What we don't like, however, at the moment, given our view of, let's say, the short-term impact that there can be on terms of economic growth globally, especially in the advanced economies, is the reason why we are underweight in IT. We believe that information technology historically has had a very strong correlation to the GDP growth rate for developed economies. Given that ceteris paribus, compared to, let's say, 8 months ago to now, growth rates in the US and in Eurozone and in some of these developed economies is supposed to be much slower than what was anticipated. We are still cautious on this sector. Currently, the management commentary does not indicate of any slowdown. However, we would like to note that commentaries typically are not the best indicators of the slowdown that one can see probably 1 year down the line. However, what has really transpired as firm actions are, let's say, the startup firms reducing the manpower, basically taking job cuts. We have seen how the funding pipeline drying up. So liquidity in the system has dried up to the extent that new companies, startups are not able to raise the additional subsequent rounds of funding, capital through those rounds of funding, which eventually is basically reducing the capital that is available at their end to spend on things like information technology. While there is a bull case argument that some of these technology spends have become more staple in nature, that means they've become more necessary than in the past. History has indicated that typically the growth rate does slow down if the global GDP, or the more importantly, the growth in advanced economies goes through some sort of a slowdown. Having said that, valuations still, despite the recent fall in IT, are not yet in the zone where we would call them completely attractive. We find more value in the sectors that Sanjay and I mentioned, where we are more focused on the growth that is going to happen in India because of the reforms and efforts that have been taken by the Indian government. And to that extent, the sectors that we are overweight plays on those sectors, or rather those environments that is currently produced in the country. Similarly, because we are not very bullish on IT from the global growth risk, materials or other commodities is the space where we are also not bullish from the same perspective, because this is typically a game of demand and supply. If the global economic growth is going to be slower than anticipated, or rather if we are not comfortable on that, then the demand supply will be unfavorable for the commodity companies. And anyways, these companies are leveraged, or rather have a very strong operating leverage that plays out. We feel that these companies recently were at the peak in terms of their profitability per ton basis, in terms of realizations, with incremental capacity expenditure that they have already incurred and some risk to their profitability. Maybe this might not be the best time for the space. So we are hence underweight on commodities and materials from that perspective. We also don't like utilities, primarily from the perspective that we don't find companies with very good return on capital and good management quality over here, again demonstrated through very good capital allocation. So that is the reason, as part of our investment process, as we've been highlighting to all our partners, distributors, and investors, that we focus on companies with good business quality defined by good management quality and good growth and return on equity. We don't find too many companies in the utility space which classify this criteria. So that's why we are underweight on that space also. Mind you, when we say we are underweight, we don't mean that we are completely out of these sectors. What we mean is that compared to, let's say, the average positioning in the overall category by the benchmark, by what generally the investors are holding, we have relatively less preference compared to what we have other sectors. So these were the broad points on the sectors that we like and why do we like or do not like them. As far as the recommendations go, we continue to recommend to invest through equity products. The premium in the equity markets have always, in India, have basically on average seen some premium to be lasting. That is because India is a growth story. And typically, when the fair values are growing fast, investors are always inclined to pay some premium for that growth rate. So at the moment, the premium has gone a little higher, but nothing that basically makes us to say that the asset allocation should change. We should continue to recommend, continue to prefer equity-oriented products. While there is a problem of what can happen in the short term, in the medium term, let's say next 6 months would be a good litmus test. Winter would progress. Most companies will give their outlook in terms of what has been the impact based on the increased interest rates. By December quarter and September quarter, we will have a good hang on some of these risk parameters. The long-term story, as Sanjay indicated, remains very intact, especially with the work that the government, the administration currently at the helm has done. The heavy lifting they've done in terms of important reforms, which while at the outset appear subtle or appear relatively smaller in nature, but their impact actually has been large enough to attract capital and attention from the MNCs. So this is the broad, take the outlook, or rather what we are seeing in the market currently. We are cautiously optimistic as we believe that India is a very fast growing economy, fastest in the world at this point of time, or the top 10 fastest growing economies on a real basis. And at the same time, the fair values across mid, small, and large are growing very fast. So with that, I would stop the discussion on the outlook and handing it over back to Saurabh.
Thanks, Hardik. Thanks, Sanjay. Can I request Philippe to come for the closing remarks?
Yep. Thank you, everyone, and to all the audience. Really appreciate your taking time out to hear us out. As Union Mutual Fund, as you all know by now, we remain highly process driven and we try not to take impulsive or sentimental calls on the market, and we try to be, as transparent as we can, and try to do what we believe to be the right thing for everyone. So that's the reason. For example, the entire last year 21-22, we were probably the only mutual fund, or one of the very few mutual funds, which did not launch any NFO, because we had a clear view that the markets were quite expensive compared to the fair value. But as valuations became more reasonable and we became, more confident about growth prospects, we have got back to launching products which we believe are suitable and will create value for investors in the long term. So I want to thank you all, those who supported us in our Union Guild Fund, which we thought was a very timely product, and something that we are quite positive about from a 3-year perspective. And similarly, we are launching our retirement fund on 1st September. Again, retirement is something that is the need of the hour, and I'm sure many people in their 50s, 60s, or later, would really be wishing that they had started planning for retirement 10, 20, 30 years back. So we believe that mutual funds in general offer a fantastic opportunity, fantastic tool for planning retirement for people. And the retirement fund itself is one of the best routes to take for planning your retirement. It by no means means that retirement planning can happen only through retirement fund, but it is a great tool to create long-term value and to help people to plan for their retirement. We will share the details of the fund with you, but I would urge you all to take a good look at it and use it for your clients who would like to plan for retirement. And the important thing is, if you start planning for it in your 30s, retirement becomes a much less painful exercise compared to starting the planning when you're in your 50s or 60s, because you need to work that much harder at that time. And we continue to invest in our teams, invest in the business, and we continue to grow very well compared to the rest of the industry. And I want to thank you all for your support in that. And we would like to actually discuss more things in the Q&A. So with that, I will stop now and we'll take questions.
Thank you, Pradeep. So there are a lot of questions, and I'll take one by one. So Nikhil from Mumbai and Hitesh from Delhi wants to know our view on small cap fund and mid cap fund. And when we say that we prefer large cap over mid cap and small cap, does it mean that people should take out money from mid and small and move into large? How do you translate that view?
Yeah, let me take that. So when we give that comment on what appears more attractive, primarily the idea is to say that currently, let's say if we have a diversified portfolio of flexi cap fund, for example, where are we more positioned currently? It is not to say that we like one particular asset category over the other, because over the long run, we believe that mid cap and small caps definitely are high risk, high return product categories. Investors will of course would require to have a longer time horizon in these categories, and from that perspective, we continue to recommend that on that basis, these are businesses which will have a very high fair value growth, and we don't feel that there is any problem in terms of the category going forward. In fact, we are very bullish on it. It is just to say that at this juncture, where would we position our flexi cap fund in terms of allocation? But this keeps changing. I understand that most investors would typically be participating in the mid and small cap through STPs or SIPs, which is what we always recommend. And this recommendation of mid versus small versus large will keep changing from time to time. So for those kind of investment strategies, any which ways, this particular comment is not very relevant. It is more relevant, let's say, if someone wants to put in a lump sum immediately today, and which is anyways something we basically ask investors. We encourage them to go through STP mode. So that is how we look at the overall small mid cap strategy. And given that the Indian economy itself is supposed to grow at a very fast pace, we are when we speak about the small mid cap strategies that we run or the universe that we create, we try to see companies which are going to grow at a pace much faster than the nominal GDP. So for a long-term investor, that's a great way to play on the Indian story. Try to participate through companies which will grow at a pace which is at least 30 to 20% higher, 1.5 to even 2 times faster than nominal GDP growth rate in our country. And if these companies continue to grow at that pace, they should hence give a significantly better return compared to large caps. But of course, while all this sounds rosy, the need, however, is to basically stay in for a long time, because volatility in these companies' performances also is very sharp, which can basically induce relatively higher holding period requirements. So we are bullish on the space. Nothing changes on that front. And the only difference is that you might have to have a relatively longer time horizon.
Thanks, Hardik. The next question is from Tanisha from Delhi. As a fund house, we've been talking about fair value for last 4 years, and our portfolios used to have companies with reasonable valuation. Of late, there are some high valuation companies which have come in the portfolio. Any particular reason for that?
Yeah, so see, we continue to look at businesses the same way. There is no change in the approach whatsoever. When companies do appear expensive on an apparent basis, let's say from price to earnings or maybe price to EV EBITDA or price to book multiple basis, that is because we believe through our investment process, through our fair value approach that we have, that they are worth that much more in terms of their relationship to their, let's say, profits or in relationship to their sales or EBITDA. And they are worth more because of multiple reasons. Probably the reasons are typically in the range of they are growing much faster. They have a significantly higher growth horizon compared to, let's say, the other companies. They have a relatively much better return on equity compared to the other companies. So we have some companies, for example, which don't need any capital. And any incremental revenue that comes basically will be straight away resulting in a very strong growth in the return on equity. So these are the kind of companies that we have added. And that is why these companies naturally will also be appearing to be expensive from the conventional method. But from our fair value perspective, these companies still appear to be at a discount to their long-term fair values, and in such a way that holding on to them would still generate a decent IRR, internal rate of return, over the holding period. Sanjay, would you like to add anything on this?
No, I think you summed up quite well. So this is also a function of the kind of opportunities which we are getting, and the way our process is working is giving us the right view of what should be the worth of such kind of companies, despite they may be looking expensive in the conventional way other market participants are used to look at. So as Hardik highlighted, process, there is no change in the process as such. This is just a function of the kind of opportunities which are available in the market, and there is no change as such, the way we are looking at these opportunities as such.
Thanks. The next question is on Nifty premium over the fair value. This is from Ashish from Bhilai and Sarang. So one of the also thought process I want to understand, in the BAF we were at 33% allocation when Nifty was at 13,200, and now we are 50%.
Sure.
So what has changed? And also Sarang wants to understand the fair value part again. How do we calculate the fair value to the like Nifty? So if you can also cover that.
So I'll take the BAF part, and fair value part, even Sanjay can jump in with that. So so I'll tell you how, first of all, the BAF, when we're talking about this 13,000 level, we are talking about the December 2021 level, if I'm not mistaken, where the market had kind of resurfaced from the bottom of the COVID-related bottom of March 2020. See, fair value is a growing concept. Nifty's fair value hasn't really declined or stopped growing. So from December 2021 to today, that is August 2022, the fair value itself has also grown over a period of time. We at that time also put out an update saying that while the profits are expected to decline in the financial year 21 because of lockdowns, the fair values are not expected to decline. They will probably grow slower. And to that extent, the reduction in interest rate, in fact, basically induced the fair values to grow actually that year. So when we are looking at 13,000 and a certain level of BAF, and we are looking at, let's say, 17,000 certain level of BAF, it is also to be seen in conjunction with how the underlying fair value has moved over a period of time. So the fair value is also grown. That is point number one. And second is at that time, we were basically coming from a level where the market had moved very sharply, whereas the fair value hadn't moved. So on a moving average basis, the market had basically become much more expensive to the fair value. Currently, what we are seeing is on a moving average basis, the market has just touched 17,000. If you take, let's say, last 3 months average, for example, Nifty was still available at a big discount to the fair value. In our BAF model, hence, we also don't take the present Nifty premium or a discount to the fair value, because we don't want the model to be very high churning in nature. We don't want it to react to short-term signals in a very significant way. What we want to do is basically let the BAF model assess the actual underlying trend of the market and then say whether the market is at a premium or not. We have done historical backtesting to see what makes more sense, keeping in mind, forgetting even the transacting cost of simply rebalancing that frequently, even by assuming a more smoothened out BAF model where you take an average of Nifty prices, not the current day Nifty price and the fair value. The taking a smoothened approach basically has resulted in a significantly better risk adjusted return for the BAF strategy that we have been running. So that is the reason why likening the Nifty level at some point of time with the BAF level might not be correct. The moving average of Nifty will keep changing and the fair value is also constantly growing. So that is why we are at 50. And we have also moved, by the way, from 250% from 33% that we had in December 2020-21. So just about 8 months ago, we were at the bottom of the investment in the BAF model. So from there to now, we have increased the level because we believe that Nifties are closer to their fair value. While for the longest of the last 15 months, Nifties actually has been at a premium to its fair value. So that is the reason why BAF is where it is, and how we construct the fair value and how does it be constructed for the Nifty. I'll invite maybe Sanjay to talk about it as well.
Yeah, thanks. So fair value is a very intuitive concept. So let me give you one example, and maybe that would be useful for us to imagine how this fair value is getting calculated rather than getting into too much of technicals. So our philosophy is that businesses make money, and typically equity, as an equity investor, we tend to give the value to that equity portion, what is in a way discounted cash flow generated by that business over a period of time. So if you can imagine a bond, right? A bond which is making, let's say, or a fixed deposit which is giving us 8% return. Typically 8% is the annual interest rate which we are expected to gain out of it. On equity side, let's assume that a business which is making 20% return. So entrepreneur has set up a business using land, labor, capital, and entrepreneurial skills, and now he's generating 20% return on equity for that business. So imagine a business case where you are getting 20 rupees for the 100 rupees of invested, and there is a cost of that capital. So cost of capital, let's assume for the simplistic nature, is what interest you could have given on the fixed deposit, let's say 8%. So in a way, this gap between 20 rupees which you are earning and 8 rupees which you are going to give for the getting that capital in hand, that is what we as an equity investor is rightly, we are the owner of that 12 rupees of gap, which should come to us as an equity investor. It's not that very straightforward that way, by the way. So for example, changes in taxation regime, changes in inflation, changes in riskiness of the business, all have implications on this calculation. So just to give, coming back to the discussion, so 12 rupees of earning, 12 rupees of business is making every year and for n number of years. So that is what is discounted back today, and that is what we are calling as a fair value of that business. It has repercussions. It gets impacted by riskiness of the business. It gets impacted by the interest rate regime changes. So when there is this 20 minus 8 I'm doing, instead of 8 now tomorrow interest rate goes from 8 to 9%. So I will do 20 minus 9. So 11 rupees has to accrue to the equity investor as a rightful gain over a period of time. So the interest rate changes, taxation changes. So when government changed taxation from 33% to 25%, suddenly fair values for all these companies which we track jumped by 9% approximately. Because now as an equity investor, earlier we were paying 33 rupees from our profit before tax as a tax. Now we are paying 25%, and we are accruing more for more gain is accruing to us as investor, and that's why fair value jumped. And that is the concept of fair value I just wanted to mention. How we calculate the Nifty fair value? So in our fund house universe, there are approximately at any given time between 170 to 200 companies would be there in our fund house universe. And we have fair values for all these companies based on our understanding of the business, which we have modeled for long period of time. So there would be fair value for FY20, how much this business should be worth, fair value for 21, 22, FY23, 24, and so on and so forth. When we combine the fair value for 50 companies in the proportion of what Nifty proportion is, and then in a way we get the fair value what Nifty should be trading at, and all the components. And that's why we may be having, by the way, for your information, there is one very good research report on our website where we have done some work with respect to how this fair value should be looked at, and how price to earning ratio of Nifty, how it has been differently looked at by the market, and how we are thinking it should be looked at. So this fair value concept, I just wanted to connect to Nifty, that summation of all these 50 companies fair value in the proportion of Nifty gives us the understanding that where Nifty should be trading, what should be the true worth of the Nifty at any given time.
So just to also then conclude on how this actually is helpful to us compared to looking at any other method. Let's say that the fair value of your apartment is hypothetically 1 CR, 1 crore, and you are earning about 3 lakh rupees of rent from it every year. If because of pandemic, someone did not pay you half year's rent and your rent goes down to 1.5 lakh for that year, you are not going to say that the fair value of my apartment, which I was before pandemic able to sell for 1 crore, has fallen to 50 lakhs. Your property is worth the same. It's a long asset, which is a long life, whose value is constantly appreciating as the economic development around it happens. As more roads get built, as a new railway station comes, the value will increase. But your half year's profits are gone. So that is why we use the fair value as a concept, because it discounts, as Sanjay said, the economic profits of a business over the long run, and then it judges whether the thing that you're trying to buy, is it available at a discount or a premium, which is what the Nifty's fair value is. So that's how we actually use it, and why we feel it is a better way to judge the market's attractiveness or expensiveness at any given point of time.
Thanks, Hadik. So there are 3-4 questions which are similar. Chandra from Mumbai, Rajesh from Bangalore. If you look at, we have seen market being extremely volatile in the last 3 months, and the narrative has changed very, very quickly. Currently, the narrative which is going on in India and the US market is that Fed rates have almost finished off with the hike, and the hikes will not be very steep going forward because there will be inflation coming down or the growth slowing down too much. So is this the hope rally? Is it a start of another bull run, or is it a bear market rally? And it is sustainable.
So, okay, great. That's a very good good summation. Couple of things asked at the same time to give a good sense of the market. So as I was discussing in my part of the discussion also, part of the point highlighted is fair, that inflation seems to be peaking out compared to what the inflation levels were in April, May. They are coming lower. Even in some cases, central banks are saying that the pace at which you are going to raise the interest rates, we might slow down a bit. So to the extent that market have seemed to get a little excited about the pressure already being known, there is nothing incremental. Partly it is correct, because yes, these pressures seems to be easing off. What equity investors, however, need to be worried of, when we say fair value, as Sanjay also explained, there are 4 components to it. One component is the return on equity. Second component is the growth. At what pace will this business keep growing into the future? Third component is the risk-free rate, which is the interest rates which we are all talking about. And the fourth component is the riskiness of the business. While market currently has understood and probably is excited about the fact that risk-free rate has gone up, so one component of fair value, as we can explain, they understand how much it has gone up by, and they have a better handle on how much further will it go up by. What I think is yet not understood and is yet to transpire is the impact that some of this increased interest rates will have on the other 3 parameters. Businesses on the margin will grow slower than expected, is what our fear is, which we feel the market has at the moment not completely captured. Part of the reason for that is the current quarterly result seasons for the companies have come in line with expectation. Management commentaries are not indicating of any slowdown. And clearly, India is a great long-term story. So quite a few companies have actually reported growth that have surpassed the pre-pandemic levels. So there is some positivity, and people are of the opinion that the higher interest rates would be absorbed by the system locally as well as globally, probably. But the growth part of the fair value, the first component is where we are concerned that it's not completely understood. And maybe the market is getting the impact on the risk that can come from the risk-free rate going up, but not from the growth perspective. The second impact, Saurabh, also is on the riskiness of the business in a volatile environment that we are in currently, where there is a geopolitical tension playing out in Europe, and its impact that can have on the Eurozone and the advanced economies, which, by the way, depend on gas as one of the biggest forms of energy to heat their homes, to basically undertake manufacturing. With the winter coming in, the demand for energy spikes over there. Unlike in our country, where in summer the power basically demand peaks, over there winter is when the power demand peaks. And energy imbalance in the supply and demand probably can have a very big issue. So to that extent, the businesses will also experience significantly heightened volatility over this period. As we have already seen in the quarterly results, by the way, that have gone by, some companies have already witnessed an impact on profitability. They have taken price increases to pass on this impact to customers. But we have to bear in mind that this increased prices will, in a way, at some point affect demand also. You can't keep increasing prices and assume that the consumption will be the same. So our opinion is that the increase in interest rates are fine, but what it will end up doing in terms of business growth, what it will end up doing in terms of consumption patterns, what impact it will end up having in terms of volatility, these are the things that are not yet fully understood and are a risk. That's how we are looking at it from the perspective of where the current situation is from here. Whether we are at the start of a bull rally, or I think Sanjay, if you want to give a comment on whether we are at the start of a bull rally or whether it's just a dead cat bounce.
Sure. So before I go there, so just a couple of points which I just wanted to highlight on this earlier part also. So if you look at since 1980s, the bond market is rallying, right? So in the US bond market, the interest rate regime is going down for last almost 35, 40 years. And now that is reversing. And it is not 6 months, 1 year kind of a game. If you look at since 2008 to 2022, Fed balance sheet has expanded materially, almost more than 50%. And Fed is now talking about reducing their balance sheet by $95 billion per month as such going ahead. So since interest rate is one variable, contraction of or sucking out of this liquidity, contraction of balance sheet, the impact which it will have on the capital markets, on the asset pricing is something which we have to completely assess. One area which I would like, actually, in fact, our CIO, Mr. Vinay Paharia, had tweeted it also in the Elizabeth Warren testimony, where Fed chairman had indicated what is the end game, what is that they're planning to achieve by doing this. So they called about 2-3 areas what they are planning to achieve because from this rising interest rate regime or this reduction in the Fed balance sheet going ahead. One thing which we have to understand is that Fed controls the demand side as such. Supply side is not in control, right? The Fed cannot, or any central bank, by the way, cannot start the manufacturing facilities or cannot incentivize the production as such. What they can control is the demand side of the equation, particularly on the manufacturing consumer durable side, because that is where the financed consumption actually takes place, where people take loan to consume such kind of goods, and that is what Fed controls. And in the testimony, it was clearly mentioned Fed wants to achieve 2-3 target areas where they are targeting. One, they want to reduce the demand. Second, they want to, and how they will reduce the demand is obviously by either sucking out this liquidity or maybe reduction in the employment going ahead. That can be another tool. They want to reduce this asset prices, mainly on the equity side as well as on the debt side. So asset prices reduction means the correction in the market. which possibly can happen through the engineering recession, which they global macroeconomics are talking about, and strengthening of the US dollar, which we have already seen. The dollar has already strengthened to a multi-year kind of high as such from across the asset classes, across multiple currencies, across the commodities as such. And those are the areas which Fed is targeting to do going ahead. And that's what is actually playing out. And just to come back to your earlier question, that what this impact of the sucking of liquidity from the market it will have needs to be understood clearly. It will have layers of second order, third order impact, as Hardik was highlighting, and that is what is likely to play over multiple years, if not multiple quarters as such. That is one. Second, on the rally, whether it's a bull market rally, bear market rally, honestly, it is very difficult to mention. It will be known in the hindsight typically that, okay, this was a great time to buy. And that's why if you go back to our earlier discussion of March 2022 webinar, where we thought that since market was coming market was available or trading at a discount to our fair value, we had come out and put our neck and said this is the great time to buy Indian equities. And that is what we get visibility as such from our fair value and our process, fair value model and the process which we conduct at Union Mutual Fund. Currently, we are feeling that India is at a good spot, and we are cautiously optimistic as Hardik, Pradeep sir, and Saurabh had highlighted, and that's how we are approaching this market. So, any opportunity which is available to us, which is reasonable in terms of valuation, providing good growth, is something which we are buying on at the opportunistic time, rather than making a guess or making a assessment that whether it's a bull market rally or bear market rally.
Thanks, Sanjay. The next question is, when interest rates are going up, this is from, again from Tanisha from Delhi. When interest rates are moving up, why are we overweight on consumer discretionary? Isn't it, counterintuitive that rates are moving up and consumption will come down, especially on the discretionary goods?
Yes, that's a interesting observation. Well, again, we buy. I think the same person also asked a question: are we buying things which are at a premium to higher valuation? See, again, we follow the concept of buying things that are at such a level that the fair values currently and into the future. If we buy a business and we hold on to it, then for the holding period we will generate a significantly better holding period return, internal return, rate of return. While the point is correct, as Sanjay highlighted, for some of the consumer discretionary companies, like let's say auto, two-wheeler, four-wheelers, we are not even going to surpass the 2019 volume levels in 2022. So to that extent, a lot of pent-up demand is there. And a lot of this demand that has been unmet is not because of the underlying demand being weak. When new models are being launched, we are seeing the kind of, let's say when a new car model is being launched, we are seeing the kind of demand that comes up for it. We are also hearing that all this issue is because of production. Chip shortages have resulted in companies not being able to manufacture cars in the same way that the demand has gone up. So the reason for being overweight is because while there will be an impact compared to what was the case earlier, there is still a lot of pent-up demand in a lot of these cases. Consumer discretionary, by definition, means higher ticket items. This whole category has seen relatively far lower consumption compared to, let's say, in the pandemic period, compared to what the growth can come, assuming even that, as Sanjay indicated, we are not even going to see 2019 levels of volume coming back in some cases just touching 2019 or 20 levels of volume. Assuming even this kind of a scenario, the valuations appear attractive. So that is one reason that as far as growth expectation is concerned, growth expectations are already pretty moderate. They are not very high. They are not assuming a very blue sky scenario. So that's point number one. And the point number two is to understand that, when we are looking at, what to invest at this point of time, in a scenario where interest rates are going up, we have still, money of investors that we have to choose where to allocate. We are not allocating hence in companies which are geared on global growth, global demand, like IT or materials or commodities, as we said. We are hence saying that if we have to choose at this point of time, which growth story is better, then we say India growth story is better, India consumption story is better. And for the valuations and the prices they are trading at compared to the fair values, a lot of consumer discretionary names make a lot of sense. So while the overall point is correct, I think we are getting a decent price at which we are able to buy these businesses, which have historically grown at a very fast pace. India is a consumption story. 55% of the GDP, 50% of GDP typically comes from private consumption. So to that extent, that doesn't go away. And valuation suggests that if we hold these companies for the long run, we'll make a very healthy internal rate of return, which makes us make this decision.
If I may also add a bit, Saurabh here. So, see, another area which is also there in the consumer discretionary is this production-linked incentive benefits which are accruing, right? So we had brief discussion at the start of this call when we discussed that whether global MNCs are making India as a manufacturing powerhouse. And so, if you look at our fact sheet, some of the names which we have in our portfolios are clearly partners of these global MNCs, where global MNCs are talking these Indian counterparts to make them as a part of global supply chain. So if you imagine, let's say India in a total overall global scale is much, much larger for all these big companies. And India is a very fractional of what their global supply chain is. And even a part of that global supply chain shift to their Indian counterparts, there can be a complete turnaround in these names. And that is what is also one area which we are targeting through our allocation into consumer discretionary, because it also includes automobile parts and some of the auto OEMs which are part of that sector.
Thanks, Sanjay. So coming back to our earlier question on the bear rally, hope rally, or the bull rally. Now, a lot of advisors have asked this question that when the client has to invest money right now, and a lot of clients are sitting on the sideline waiting for the correction to happen now. What should be the strategy for the advisor? Are these risks all short-term in nature that they will play out in 3 to 6 months? So one way is that we start doing STP for 3 to 6 months, or should we do STP for 1-2 years? And typically, what funds do we recommend for doing STPs at this juncture? And like what should be the period of the STP?
We have always encouraged investors, first of all, to do STPs and not necessarily do lump sum. The reason for that is because honestly, it is difficult to identify the best price to enter the market. So STPs are always recommended. We have been recommending 6 months STP when markets are close to their fair value or at a slight premium. So currently that is the situation. So our suggestion would be that STP over a period of 6 months makes more sense. And as far as the product category goes, I think the decision at this point of time is left to the investors' risk appetite. If the risk appetite and return requirement is such that they should be investing in higher risk products with higher return maximization opportunity, like the small caps, mid caps, focused funds, that's where the capital should go. At this point of time, the way we see is that markets are at a slight premium to the fair value. They've always been at some premium. Today, the premium has gone up, but that keeps changing from week to week. So hence the decision of which asset category, which product category to participate in is at this point of time purely an outcome of what the investor really needs in his goal.
If I can just add a point there. As Hardik rightly said, which product is right? It's very specific to individual investor. It's not possible to give a generic advice. But one thing which we have always recommended is that if you're looking for a pure equity fund, and if you had to choose only one fund, we would typically say go for a flexi cap fund, because that gives you pretty much the entire market, large, mid, small, all sectors, everything. And if you want to have that equity market exposure, a flexi cap fund, if you had to choose only one fund, we would say go for that, right? But that can be the core of your portfolio, and then depending on the risk appetite of the person, you could add a bit of mid cap, bit of small cap, etc. But flexi cap is a generally a safe bet if you have to choose a pure equity fund.
Thanks, Pradeep. Continuing on the question, Amit from Delhi, he said the client has the money for 5 to 6 years. So we have already answered lump sum STP for 6 months. Ideally, what should be the asset allocation at this valuation of the market? So if he's building up the portfolio, a new client comes to an advisor, what should be the asset allocation between equity and debt that we would recommend for the client from this juncture?
Sanjay, you want to take this? Should I take it?
No, it's fine. Yeah. So if you look at from long-term horizon, long-term perspective, definitely we feel equity is a very attractive product. Equity is expected to give you very good decent returns. In fact, inflation beating returns over a period of time, and that's what this asset class is meant to be. So based on the risk appetite, one has to assess what kind of equity allocation should be there. But I would think that whatever equity allocation, maximum equity allocation one can think from long-term perspective, I think one should definitely look at the asset allocation from that perspective when you are looking at equity versus debt as such. And since market is currently trading at a premium, that's why rather than lump sum, it is preferred to have this route of staggered entry into the market as such going ahead.
Thanks, Sanjay. There are a couple of questions from Venkatesh from Bangalore and Sharon from Lucknow on the BAF performance. I take that. So, there is a perception that our BAF performance has come down. And yes, I will tell you the way we look at our performance. So, first of all, if you look at it, the BAF performance on a point-to-point return, which is as on given date, what is the return of the fund? So, as from yesterday, the 1 year return of BAF was, the ranking was 12 on 21, 2 year was 12 on 20, and 3 year was 6 on 19. This is a point-to-point return. Now, when you're looking at any equity product or any hybrid product, first of all, looking at a 1 year or 2 year performance, not only for us, for like any fund house, does not make sense. Because fund may outperform, fund may underperform. And I would also like to go on record to say, if on a 1 year period we are number one or number two, a lot of luck also plays part in that. We are not, it is not planned to reach number one in 1 year period. Because the way we manage the fund, we are very, very cognizant of how much risk we are taking to generate return. We want to generate superior returns in the category for the client and for the advisors, but taking an acceptable level of risk. The second way to look at the return is a rolling return concept, which many of you know. But just to give you a simple example over there, there's a batsman who has scored 100 in the last inning, and there's second batsman who has scored 40 in the last inning. But there's another data point which says out of the last 50 matches played, the first guy who scored 100 in the last inning, his average is 30. And the second guy who scored 40 in the last inning, his average is 55 runs per inning. Now, rolling returns are similar. What they do is they take multiple point-to-point return and they compare the performance based on multiple data points, which give you a trend of the fund. Our investment objective is designed in a way that in any category we are operating, we have to be consistently above average and give superior returns to our clients and our advisors who are advising their client. And the experience is same for all the funds. So we don't have a concept of a flagship fund, right? So there's a question on which is the fund that we should recommend. We say advisor needs to decide what the client wants, right? But at this juncture, if you want a core portfolio, FlexiCap is what we are telling you to invest in. When you look at the outcome, if you are managing all the funds with the same process, same hard work, the outcomes needs to be similar. Because when you're following a process, for all the fund outcomes are same. So I'm sharing a slide with you, which will give you a rolling return perspective on how the funds, just give me a sec, please. Just tell me if the slides are visible.
Yes, they are visible.
So if you look at it, this is 1 year rolling return taken every day for last 1 year. Now, for each of the fund, you can see how many times was fund in quartile 1, quartile 2, quartile 3, quartile 4 compared to the category. How many times the fund was in Q1 plus Q2. Based on Q1 plus Q2, what is the ranking in the category? So if you look at a balance advantage fund, on a 1 year rolling return taken every day for last 1 year, the ranking of the fund is 6 out of 26, which means it is in the Q1, Q2 border, very close to Q1, right? And these are more than 200 data points, which shows the fund is consistently above average. And this is the experience we are trying to create across the fund. So if you look at all our funds, in the ranking parameter, no one is in quartile 4. They are either Q1, Q2 or very close to Q2, Q3 border, couple of them. But this is what the process is trying to achieve, give that consistency of performance over a long period to our distributors and our investors. And eventually, you will see, because of this consistency of returns that we are trying to achieve, funds automatically over a long period will be in quartile 1, and which has happened to FlexiCap and BAF already, and even the long-term equity fund. Even the mid-cap fund is at number 1 on the rolling return basis. So which is what we are trying to achieve. And when you're looking at a fund performance on equity and hybrid, I would like to repeat, whether you look at us or like anyone else, 1 year performance actually does not reflect how the fund is doing, point to point especially. If you look at a rolling return, it gives you multiple data points and it tells you how the fund is on multiple data points. Right? So, which is a case in point. So the BAF is a fantastic category, and our fund is doing extremely well in that category. Right? Looking at 1 year return, the fund was number 2 in 2020, now it is at number 12, is not the right way to look at the fund, right? Because there are times when the fund will be number 1 in quartile 1, there are times when the fund will be in quartile 2, right? If the fund manager KPI is to be consistently in quartile 1 or be in the top 3 fund, he will be bound to take extraordinary risk in the portfolio, which can also result in a big risk in the fund. Hardik, Sanjay, you want to add anything over here?
I think you summed it up really well. There's nothing else to add from my side.
Yeah, same here.
Thanks. Vinay from New Bombay has a question. The latest China-Taiwan. So we are not out of Russia-Ukraine, and now the China-Taiwan news is coming in. Does it have? Is it going to have a real impact on the market? And how how do you see it as a risk? Do you consider it as a risk? Do you watch it when you're looking at the equity valuations?
I will take it. Hadik?
Yeah, yes, please.
Yeah. So, China, Taiwan conflict, obviously it's a conflict at our neighborhood next door only. And obviously big economies involved, and that's why we are looking at this area. As of now, monitorables are very limited, honestly. However, this may impact us in a couple of ways, right? So 2 points on that. Number one, if you look at Taiwan manufactures a lot of semiconductors for the world. So semiconductors, where do they go? As the name suggests, it's a semiconductor, right? It's neither non-conductor or full conductor. So it has a switch, and which leads to either on or off possibility. And that goes into a lot of electronics, a lot of automobiles, where this on-off kind of a possibility is required, or functionality is required in that those devices. And that's why semiconductors are now part of most of the consumer electronics and automobile devices as such, including, by the way, military usage as such. The data suggests that 92% of the world semiconductor is manufactured in Taiwan. So obviously, if this conflict happens, it may lead to some supply chain disruptions going ahead, which needs to be understood. As of now, all the companies which have already gone through this semiconductor shortage are holding a lot of inventories at their own end. Apart from that, customers are holding in the inventories for future usages. So for some period of time, if this conflict happens, there would not be immediate impact. However, global supply chains may be at a risk if such kind of conflict happens. That is point number one. Point number two, the Strait of Taiwan, right? Strait of Taiwan is very important shipping route globally. So more than half of global shipping traffic happens through Strait of Taiwan. A lot of oil, gas get exported, imported. So a lot of large ship moves happen through Strait of Taiwan. And that's why that is also very important shipping route globally. If any conflict happen, that shipping route may come under question, or it may be at least stopped or get disrupted for some period of time. And that's why these two are very critical components from the immediate or maybe from short term, 6 months to 1 year kind of perspective, to monitor that if such kind of conflict happens, it may have impact on the global supply chain as well as the shipping routes as such. Second order derivatives, or what will happen, this will lead to global economy, whether recession on the consumer side, what it will have implication on foreign exchanges, what kind of implication it will have, obviously needs to be assessed at that period of time. But currently, at least we are monitoring it from the variables which are accessible to us. And these are the two variables which may have implications for Indian market as such in the medium to, in the short to medium term as such.
Thanks, Sanjay. Pradeep, if you can take the next question. So this question is from Mr. Rajesh from Dubai. Why should he choose Union AMC over other AMCs?
Yeah, I think that it's very easy to say, probably very tempting to say that we have the best performance and we will produce the best returns, etc. But I don't want to make such statements. Okay. Again, it really depends on, as an investor or as a distributor, what are you looking for? If what you're looking for is consistent, reasonably predictable kind of performance over the long term, I think we are, very well placed to produce that because of the process that we follow. Not only that, we have a good process and we follow that process diligently, meaning we don't make any exception. There is not a single stock in any of our portfolios which has not come through our rigorous filtering process. The whole PMV, process and the fair value process, we follow that diligently. So what this gives us is the ability to produce fairly consistent, above average returns, right? We don't even aim to be number one or in the top three. We are, in the top quartile very often, but we don't start with the objective that we had to be in the top quartile or in the top three. Now, if you are looking for reasonably good returns consistently over a period of time, I think we are a company which is very well placed to produce that. And we have been doing that over the last 4 or 5 years. On the other hand, if you are looking for, the explosive, exciting kind of returns, like, market is giving 25%, you want 50% returns or 75% returns, we are probably not the kind of company which can do that. Because we take our responsibility very seriously. It's public money. So we don't play around with that. We invested as if we are investing our own money. In fact, most of us, including, all the people on this call, we have a substantial part of our personal money in our own funds, right? So we act in a very responsible manner. And we don't think that, this is like a playground where we have to show off our skills. That is not what we try to do. We try to produce, reasonably good returns with as low a risk as possible. It's our job to take risks. So we are not saying that we don't take any risk. We do take risks, but we take certain acceptable level of risk and knowing what risk we are taking. So again, in cricket parlance, if you are a person who admires Rahul Dravid kind of approach, I think, you would like us. But again, if you are looking for excitement, you like, at least the old timers would remember, if you like the Krishnamachari Srikanth kind of batting, yeah, we are probably not that kind of player. I mean, great batting when it works, but we try to bring in more responsibility into our investment process. So that is why I think you should choose us, because of this highly process driven approach and all the added benefits which come because of that process. I don't know whether I have answered that question.
Yes, you did. The next question is in the pharma sector. So we have not mentioned underweight, overweight, but what's our view on the pharma sector?
So we are equal weight on the pharma sector in certain categories. In some categories, the position is more overweight. So why we don't call it out is because we feel that there are certain parts of the sector which have some challenge. There is a pricing pressure in the US, for example, and large pharma companies have a decent proportion from anywhere from 35 to 55% of their revenues coming from the US. And things are always a challenge in that part of the world as far as doing generic business is concerned. And most pharma companies are generic companies, whether they are selling chemical generics or they're selling biosimilars. So our current opinion is that that part of the pharma market in our country has some challenge in terms of growth. At some point, they were available at a very good valuation compared to their fair value. So they were available at even a discount, a material discount. Since the pandemic, pharma companies actually have done much better. There was one sector which actually did not suffer anything because of the pandemic, did not lose any capital, did not lose any growth actually during the pandemic, and that price to fair value converged. So we were a big overweight during the beginning of the pandemic and through the pandemic. Once that price to fair value converged, we are not completely overweight on the sector. We have pockets of opportunity which we like on the large cap space. On the mid cap, the opportunities are different altogether. So I would say when we say pharma, we look at healthcare. And today, healthcare in our country is not just, of course, the pharma companies, what it was the case, let's say, half a decade or decade ago. Now you have hospitals, you have diagnostics, you have medical device companies, you have companies which are doing contract manufacturing. So when we look at healthcare in total, then there are some companies that we do like. They are, however, not in the large cap space. They are on the mid and small cap space where we are more overweight. We like hospitals, for example, a lot. We believe that the bed capacity and this pandemic has taught many countries, including India as well, that there is a lot of prudence in adding hospital infrastructure. No country, of course, can be pandemic ready ever. But having said that, the bed capacity as per, let's say, even WHO standards is pretty low in our country, and the opportunity is strong. So many businesses are actually very efficient in their operations. There is a huge scope for adding beds in every jurisdiction that these hospital entities operate. So we like this sector a lot. There are a few companies that are generating very good return on capital in a sector that is considered to be very difficult to generate return on. So we are bullish on those companies. So within healthcare, that is what we like. Again, these fall in the mid cap and small cap category. We don't like diagnostics, again, because we feel that there is a lot of competition coming in and return on equity that these industries make are at risk. So from that perspective, we like hospitals, we like certain contract research manufacturing companies, certain API companies, which basically will be playing a role of global suppliers going forward. That's the space that we are more bullish on. Diversified pharma companies which are selling generic medicines across the world, we are not so bullish on because we feel that valuations are relatively full and the risk on growth is also there. So that's how we are equal weight, hence in large cap, less overweight, in mid and small cap, relatively more overweight.
There's a question from Mr. Mulli from Chennai. Client has got SIP for 20 years. He wants to do SIP for 20 years and a lump sum investment for 25 years. Objective is to create wealth. Risk profile does not matter. He's okay to go to any kind of fund. If you have to choose one fund for both, which fund would you recommend for SIP for 20 years and 25 years lump sum investment?
I guess if I was to say that if that is the risk, the time horizon, then of course return maximization automatically ends up being the objective for this profile of an investor. Then I would recommend a small cap or a mid cap fund, primarily because these companies, at least the way these companies are identified in our fund house universe also, is by identifying companies which are going to grow at a pace much faster than the nominal GDP growth. An investor who is looking at that longer time horizon is definitely looking to grow as well at a much faster pace. So my recommendation, of course, would be that it makes sense to then look at categories which will give you highest return potential. Since the horizon is long enough, I'm assuming the volatility in the short term can be weathered. So that's the recommendation. Saurabh, Sanjay, if you guys have a different point than what I made, please feel free to jump in.
I completely agree with you, Hardik, on that. That mid cap or small cap, but the only thing is investors should not look at the portfolio every month, every day, it doesn't work. He has to fill it, shut it, forget it, and look at it after 20 years if he really wants to create wealth. And why I would say that, if you look at on an average mutual fund industry, while we all talk about long term as an advisor, you talk about long term, we such a fund house talk about long term, but assets really don't stay for long term in the industry. SIPs, most of them switched, they are taken out or stopped in 3.5 years. Lump sum investment in equity, right? Very few of them cross 3 to 4 years. The reason for that is the convenience that we get. Every month we keep looking at a valuation, and if the client needs money, the first port of call is mutual fund, compared to like FD or any other class. The true wealth is created if you are staying invested for long term. Does not matter which fund house you choose, but if you stay invested for 20-25 years, you will create wealth. Your CAGR will be in double digit over a long period. You will beat inflation. You will create wealth. And one of the reasons why we also like retirement fund. Retirement can be done through like any of the product. People can buy flexi cap and do retirement. People can buy small cap, mid cap to plan for their retirement. Unfortunately, the staying period is not that long. Retirement gives you a forced discipline, like a PPF. People like PPF at 8.5% CAGR. Imagine if a fund gives you double-digit CAGR, what can be the wealth you can create? So at times, the forced discipline is better, right? And for long term, coming back to the question from Chennai, Mr. Moli, if the client is willing not to look at it for 20 years, he will create wealth in that category. Mr. Hujefa from Mumbai asked, if an aggressive investor want to invest lump sum with a 2-year horizon, which fund would you recommend? Can I take that?
Please.
To be very very honest with you, ask him to not get into equity or hybrid category for me, because while 5-year looks good, what happens? Equity markets are not linear returns. First year can be negative, 2 years can be negative, and third year you may get supernormal returns. So coming with a 2-year horizon, even if you're aggressive, at least from a fund house perspective, I would say don't get into these categories. It's more like you're trying out your luck. And if you're trying out the luck, then you can pick anything. There's no guidance over there then.
Yeah, in fact, I would go to the extent of adding that, if you're trying out your luck, you are better off buying lottery.
So with that,
you lose less money.
Yeah, with that we come to the end. We have covered most of the questions. Once again, thank you everyone for joining in. Just to sum it up, as a fund house, our view is that markets are not very expensive. They are at a slight premium. So we are cautiously optimistic. That means we don't get into it whole hog. We go through the STP mode. STPs we recommend right now for 6 months. Our belief is most of the risk in the market will get played out in short period, and all the tailwinds will play out over the longer period. So next 1 year journey can be volatile, but also sitting on the sideline does not make money. So that's the way that you have to, we are telling, all our investors and distributors that right now valuations are not very expensive. They're at a slight premium, but over the 5-year period, even at these valuations, you will make a return much over traditional products. So this is the time to start getting into the STP mode daily, weekly, whatever, for 6 months. If the money is really long term, does not matter at what valuation you are getting in. Eventually, you will make your money. When I say long term, it is like 10 years. So even if you put lump sum right now, it does not matter. So thank you once again, everyone, for joining in the call.
Thank you.
Thank you, Hardik, Sanjay, Pradeep.
Thanks.
Take care. Bye.
Thanks, everyone. Thank you.